Hi and welcome. If you are self-employed, a freelancer, or a small business owner with no full-time employees, chances are you've heard about the powerful tax benefits of a solo 401k. But here's the big question we'll tackle today. Can a solo 401k be a Roth? Spoiler alert, yes, it can. But the how, why, and when is what really matters. So stick with us because in today's session, we're going to break it all down in a way that's crystal clear. As always, go ahead and shoot over any questions you might have during the live stream here. We'll answer those questions as they come in. So don't hesitate to go ahead and post those questions. Today's daily webinar is for educational purposes. We use these daily webinars to not only answer questions that you might have live on the air here, but we also cover certain topics. And as I stated already, today's topic is, can a solo 401k be a Roth? Well, here's a sneak peek of what you'll learn today. The key difference between traditional and Roth solo 401k contributions. Who qualifies to make Roth contributions inside a solo 401k? How Roth solo 401k contributions affect your taxes, both now and in retirement. The rules for Roth rollovers and in-plan conversions. The mega backdoor Roth solo 401k strategy and why it's a game changer for high earners. Plus, common mistakes to avoid when setting up or using the Roth Solo 401k feature, aka designated Roth account. So let's dive in because understanding how a Roth Solo 401k works could literally save you tens of thousands in future taxes. All right, so again, go ahead and shoot over any questions you might have during the live presentation here, and let's get started. So, regarding the key differences between a traditional and a Roth solo 401k contribution, it comes down to whether you want to save taxes now or save on taxes in the future. Pre-tax solo 401k contributions, also known as traditional solo 401k contributions, those are deposited on a pre-tax basis if made as an employee pre-tax contribution, thereby reducing your taxable earned income on the employee side for the year. Then there's the employer Roth solo 401k contribution, as well as the employee Roth solo 401k contribution. So those contributions are a little different in that employee Roth solo 401k contributions do not reduce your taxable income for the year because they are made with after-tax funds. Now, employer Roth solo 401k contributions, those stem from Secure Act 2.0, where you can make it as where you can make the employer profit sharing contribution as a Roth solo 401k contribution and you get a tax deduction on the business side. So for example, let's say your self-employed business is taxed as a S corporation. So let's say it's an LLC taxed as an S corporation, and you decide that you want to make employer Roth solo 401k contributions, which would be 25% of your W-2 wages that you receive from that LLC tax as an S corporation. Let's further assume that you receive 100,000 of W-2 wages. Therefore, you can contribute 25% of $100,000 as an employer Roth solo 401k contribution. So that $25,000 would get applied to the Roth solo 401k holding account. And then you would take a deduction on your business tax return. So that if it's an LLC tagged with an S corporation on the 1120S, the business gets a tax deduction for that $25,000 employer Roth solo 401k contribution. However, before you get too excited about that, it's going to count, that employer Roth solo 401k contribution is going to count as a taxable and planned conversion. So you're going to have to pay taxes on $25,000 on the employee side. So it could bump you into a higher tax bracket. So keep that in mind. Now, you can also, of course, choose to make employer pre-tax solo 401k contributions. So using that same LLC tax as an S corporation example, so 25% of 100,000 is $25,000. That's deductible on the business side. On the business side, so the Form 1120S in this example, and it will, and then of course it's not going to be treated as a taxable conversion unless you decide to convert it. Those are things to understand regarding the key differences between traditional, aka pre-tax solo 401k contributions and Roth solo 401k contributions. Now let's discuss who qualifies to make Roth contributions inside a solo 401k. And again, if you're just now joining today's live webinar, go ahead and shoot over any questions that you might have during the webinar now, and we'll go ahead and answer those questions as they come in. So who qualifies to make Roth contributions inside a solo 401k? So a solo 401k is for owner-only businesses. So whether your business is taxed as a sole proprietorship, you're a contractor and you file a Schedule C, for example, or if your business is taxed as a partnership, an S corporation, or a corporation, you would qualify to open a solo 401k plan regardless of the entity type. However, you need to make sure that the business does not employ any non-owner common law W-2 employees who work 1,000 hours or more. So as long as you don't employ any full-time W-2 employees in your business besides yourself or your spouse, for example, then you would qualify to open a solo 401k plan. You also have to apply that rule across all your businesses. So if you own any other businesses that do employ full-time W-2 employees, even though you might own a separate business that it's just you or your spouse, you would not qualify to open a solo 401k plan if any of the businesses that you own employ any non-owner common law W-2 employees who work 1,000 hours or more. How let's talk about how Roth solo 401k contributions affect your taxes, both now and in retirement. So as we discussed earlier, when you make Roth solo 401k contributions, there are two types. There's the employee Roth solo 401k contribution, and then there's the employer Roth solo 401k contribution. When you make those contributions, the employer Roth solo 401k contribution, you don't get a deduction on your tax return for making that contribution. The trade-off, however, is that all those gains in that Roth solo 401k stemming from those employee Roth solo 401k contributions, as well as employer Roth solo 401k contributions, those will grow tax-free and penalty-free inside that solo 401k. As a result, once you reach age 59 and a half and have had funds in that Roth solo 401k for 5 years, so you have to meet both of those requirements, you will not be subject to taxes when you make distributions from that Roth Solo 401k plan, whether federal taxes or state taxes. And of course, you will not be subject to a 10% early distribution penalty either. Now, let's talk about the rules for Roth rollovers as well as in-plan conversions. So it's important to understand that you can transfer other types of Roth funds and retirement plans to a solo 401k, funds in a former employer Roth 401k, for example, or if you have a thrift savings plan that has Roth funds, those can be transferred to the Roth solo 401k. So those type, same thing with the Roth 403b. Those can also be transferred to the Roth solo 401k, and those transfers do not count towards your annual Roth Solo 401k contribution. And there's also no limit in the amount of Roth funds that you transfer from a former employer plan. It is also important to note that the regulations, which is a Roth IRA regulation, do not allow for the transfer of a Roth IRA to a Roth Solo 401k. Also, basis inside a non-deductible IRA, so contributions made to a non-deductible IRA, the basis cannot be transferred to a Roth Solo 401k. However, you can transfer the gains and that non-deductible IRA over to a pre-tax Solo 401k and then convert those non-deductible IRA funds basis to a Roth IRA. So that's one important thing to understand. Now, there's also the mega backdoor Roth strategy. So the mega backdoor Roth solo 401k strategy, that's where you can make voluntary after-tax solo 401k contributions to the solo 401k, and then you can convert those over to the Roth IRA or to the Roth solo 401k plan. A plan offered by a company like my Solo 401k Financial not only allows for pre-tax Solo 401k contributions, Roth Solo 401k contributions, whether employee Roth Solo 401k contributions and or employer Roth Solo 401k contributions, and it also allows for voluntary after-tax Solo 401k contributions. The Mega Backdoor Roth Solo 401k strategy is effectively a way to get more Roth Solo 401k money into your Solo 401k plan by utilizing that Mega Backdoor Roth Solo 401k strategy. For example, the overall contribution limit to a Solo 401k for tax year 2025 is $70,000. So if you maximize your Roth Solo 401k employee contribution, for example, and you still want to be able to get more Roth solo 401k money into that solo 401k, then you would utilize that mega backdoor Roth solo 401k strategy. So, for example, you would make a $23,500 employee Roth solo 401k contribution to the Roth Solo 401k plan for tax year 2025. And then if you have enough net self-employment income after making that employee Roth Solo 401k contribution, you can make the remaining amount all the way up to the $70,000 overall contribution limit. So the difference, you can make that to the voluntary after-tax Solo 401k and then convert it to the Roth Solo 401k or the Roth IRA. You can also choose to make the employer Roth Solo 401k contribution, and then the difference between the employee Roth Solo 401k contribution and the employer Roth Solo 401k contribution, when you add those together, the difference of that all the way up to the $70,000 overall contribution limit for 2020 for tax year 2025 can be applied to the voluntary after-tax solo 401k contribution, and then that difference amount can be converted to the Roth Solo 401k. So in short, you can chop up those contributions in different ways. For example, you can choose to forego making Roth Solo 401k contributions as well as pre-tax Solo 401k contributions and solely make voluntary after-tax Solo 401k contributions. So for tax year 2025, if you have enough net self-employment income, you could contribute the overall limit of $70,000 to the voluntary after-tax solo 401k plan and then immediately convert it to the Roth solo 401k or the Roth IRA. And then for those age 50 or older, you can apply the catch-up contribution of $7,500 to the Roth solo 401k or the pre-tax solo 401k for tax year 2025. It's important to understand that catch-up contributions in a solo 401k are never allowed to be made as a voluntary after-tax solo 401k contribution. There's also the super catch-up solo 401k contribution for tax year 2025, which is $11,250, and it only applies to those who are age 60, 61, 62, or 63 in 2025. It does not apply for tax year 2024 or prior years. So instead of making that $7,500 catch-up contribution on top of that $70,000 overall contribution limit, you can apply that $11,250 to the Roth solo 401k or the pre-tax solo 401k. Of course, you can't contribute the $7,500 as well catch-up. You either do the catch-up or the super catch-up, and again, it only applies to those who are age 60, 61, 62, or 63. That is, the super catch-up only applies to that population. So if you're age 50 or older, you would qualify for the $7,500 contribution catch-up. Okay, so those are things to understand. Now let's go back and talk about conversions. We talked about making Roth solo 401k contributions. It's important to understand that when you make a Roth solo 401k contributions, those generally have to stay in the solo 401k plan. You cannot transfer those out of that Roth solo 401k until you reach a triggering event, such as age 59 and a half or no longer self-employed. Whereas if you make it as a voluntary after-tax solo 401k contribution, you get to choose whether to convert it to a Roth solo 401k or a Roth IRA. So in short, the different contribution types have their own rules that apply with respect to moving those funds out of the solo 401k plan. So those are items to understand. Again, if you have any questions during the live chat here, go ahead and shoot them over. Now, let's also understand some common mistakes, which we kind of touched on already. That is, you can never transfer a Roth IRA to a Roth solo 401k, but you can transfer a former employer Roth 401k, Roth 403b, or Roth thrift savings plan, for example, to the Roth solo 401k. You also need to make sure that if you make Roth solo 401k contributions, that you do not make those to the pre-tax solo 401k. Those need to be deposited to a separate holding account within the Roth solo 401k. So it's still one plan, but separate holding accounts, aka bank or brokerage accounts. This slide here is an example of a one participant plan, aka a one spouse plan, solo 401k plan. And as you see here, it's one plan, but three separate bank or brokerage accounts. So it's not three separate plans, it's three separate holding accounts. One to hold the pre-tax funds, a second one to hold the Roth solo 401k funds, and a third one to hold the voluntary after-tax solo 401k funds. So the contributions, the Roth solo 401k contributions would get deposited to the Roth solo 401k bucket. For example, if you make voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy, those would first get deposited to the voluntary after-tax solo 401k bucket, aka bank or brokerage account, and then they would get converted to the Roth solo 401k or the Roth IRA. So those are common mistakes where you deposit those contributions to the wrong account, or you try to skip a step with the mega backdoor Roth solo 401k strategy, where you deposit those funds directly to the Roth solo 401k. Again, for the mega backdoor Roth solo 401k strategy, you have to deposit those to the voluntary after-tax solo 401k bucket, and then they get converted to the Roth solo 401k or the Roth IRA. You get to choose. So those are important things to understand. We talked about the steps for doing the mega backdoor Roth solo 401k as well at a high level. We've covered that in prior presentations, so take a look at that. Okay, looks like we don't have any other questions for today. Please go ahead and like this video, subscribe to our YouTube channel for more videos like this. And again, thank you for joining today's daily webinar. Today's topic is, can a solo 401k be a Roth? And as you just learned, the answer is yes. Again, thank you for joining today's daily webinar. Until next time, have a great rest of the day.